Automobile dealerships nearly running out of cars completely. Interest rates staying the same. The Fed, they're saying they're not going to change course. Lumber prices took the biggest drop ever. Hey, everybody, my name is JJ. You're watching Bull Boom Bear Bust. It is Wednesday, June 16th, 2021. Thank you for being here. So, wow, a lot going on today. We're going to talk about the markets, lumber prices, what's happening in the automobile industry and the car dealerships specifically, and finally, the Fed, the backbone or the Achilles heel of the U.S. economy, depending on how you want to look at it. We'll talk about what the Fed said today here in just a little bit. But first, out of caranddriver.com, Ford dealership normally stocks 1,500 cars. 1,500 cars, yes. Now they have 30 cars. Michigan's Varsity Ford is feeling the effects of the semiconductor shortage, while hundreds of new models sit a few miles away waiting for their chips to come in. I never thought I would see a Ford dealership get this low on inventory. Nothing against Fords. I'm a Honda guy myself. Fords, they do cost a lot less, but I've always had the best luck with Hondas. But take a look at this dealership, and it looks like a ghost town. And I'm wondering how many of the vehicles over here are people parked there looking at cars. Right, maybe a lot of them are customer cars. But yeah, 30 cars in inventory, normally 1,500. And my just quick math in my head on that tells me it's probably about a 98% drop in inventory. So not good. What's happening with the chips and the semiconductors? Is there any help on the way? Let's take a look here. From this article out of Car and Driver, there are signs that the chip shortage will abate. Will abate by the end of summer, GM said. This week it expects to be able to increase production in numbers starting in July. So hopefully we'll start seeing some relief again by the end of summer. So those of you that are getting FOMO right now, you want to buy a vehicle, but you think vehicle prices are going to keep going up forever. I almost said homes. I'm so used to talking about rising home prices. If you think that vehicle prices are going to go up forever and not come back down, and you're never going to be able to afford a car, hold your horses. I'm not giving investment advice. Go do what you're going to do. If it were me, I would not be jumping in to buy a car right now. Not a good time. When you see panic and mass shortages and things like that, it's typically not a good time because that's when the mania kicks in, the FOMO kicks in. People get scared and fearful of missing out. Buying something in fear is usually never a good strategy. But I don't think the car prices and the inventory is going to remain this insane for much longer. They're missing out on too much money. All these cars sitting in lots waiting for chips, basically millions of cars waiting to hit the market. So what's going to happen when the flood of cars does hit the market, when the chips are getting caught up to demand? You're going to see a pretty big correction. And we just saw it in lumber, and people thought lumber was just going to keep going up. People blamed it on dollar destruction. Of course, a devalued currency, a devalued dollar also has a part of it, but it's not the only part. There's still laws of supply and demand. And yes, they're printing money like it's going out of style. But there's still other factors in play besides just the money printing. All right, so let's talk about lumber prices next. Headline here out of Morning Brew: lumber prices post biggest weekly loss ever. Still, experts think the lumber market will run hot for years. Well, let's take a look at some information on this one. After the biggest weekly drop ever, lumber is now at $1,000 per 1,000 board feet. That's about a 41% drop from the record high which we reached last month in the month of May. Now, just for some historical perspective on this, since the early 90s, lumber's futures have traded between $200 and $600 per 1,000 board feet. Now, I'd have to check the math on this one here. A 41% drop, that seems larger than I recall, but let's take a look at another chart here. Well, it looks like it took another drop since that article was posted. Things are moving pretty quickly. We're now down to $967.90. And this is according to investing.com. This is the most recent chart here. So maybe some good news, maybe some hope on the horizon for people that are priced out of the market right now, that are waiting for prices to come down. We don't know if that's going to happen. You know why? Because the Fed meeting today, they're keeping interest rates near zero. They vowed to continue their purchases with the bonds and the mortgage-backed securities. So let's ask the question again, and maybe you can answer it down in the comments. If the economy is so good, if there is a recovery really happening, why can't the Fed just take a hands-off approach? Why do we have to have near zero record low interest rates? Why does the Fed have to keep coming in, buying bonds, buying securities? Why? So the banks can keep lending. If the banks can no longer lend, all of these bubble markets, they come crashing down. I think most of you know that by now. And the markets, they certainly didn't like the talk of the Fed, even though the Fed kept rates near zero. Just the talk of possible rate hikes in 2023 was enough to spook the markets, right? How crazy is that? The Fed projects 2 possible rate hikes by the end of 2023, but they said they're not likely to even start until the beginning of 2023. So even 2 rate hikes, which likely will be a fraction of a percent if they even do that, which I doubt they will. I think they'll possibly have to stay near zero or go negative. But even the talk of 2 what will be small rate hikes if they happen in 2023, markets in the red, all indexes, S&P, Dow, NASDAQ, Russell, all in the red, not by much, but certainly compared to all the big gains we've been seeing in the markets lately. And I believe this is about the 3rd red day in a row. But still, look at these numbers. Dow Jones, 38,851. S&P, 4202. Crude oil, a little bit of a drop, but look at this. We breached $72 a barrel. Remember when oil prices crashed to zero at the beginning of the Great Sickness and actually went negative? Now, it was interesting listening to Fed head Jerome Powell talk, and actually he's just reading off of a script in most cases. There are some questions that are fed into him. I think they may be pre-screened, I don't know. But when you look at him speaking, he always has to look down at his paper. He can't just speak off the cuff and tell us what's really happening with the economy. Now, when I heard Jerome Powell speak, I heard a lot of vague answers. And I think he's being very careful about trying to not paint himself into a corner or make the Fed look bad. But he said things like, we're going to keep rates near lows until we see full employment. What does full employment mean? Full employment sounds like 0% unemployment. That's not possible. So yes, they speak in very, very vague terms. That way they can never be pinned to a certain outcome. Right, so full employment, what good is full employment if it's just based on money printing and low interest rates and people taking on debt to make the economy look good? Right, so any jobs that are created with such a mechanism or such a move are just going to go away once the money flow slows down. So could you imagine how many jobs would be lost if the Fed pulled back out of the markets and took a hands-off approach? You would probably see a big drop. And I would say today about 90% of the jobs that we see are based off of the debt and money printing that's happening out there in the economy. You see, when banks can no longer loan out money that doesn't actually exist, when they can just create money out of thin air in the form of digits on a screen, and the more you have people borrowing money in that way, then the economy is going to look better because people are spending that money that was created out of thin air, and that creates jobs. Spending creates jobs. So that's why they have to keep this illusion going, keep interest rates low, keep rescuing the banks. That is the name of the game. That is the economic illusion that's being put in front of us here. But I know most of you are too smart to fall for this. So keep on stacking, keep on preparing just in case these boneheads keep going with this economic bubble blowing behavior. But also, if it were me, I would keep some cash on the side as well. The scary part is we don't know how soon, so prepare yourself in the meantime. If you have an asset that takes a big surge up in value, maybe sell some of it off. Right? I'm not telling anyone to go out and sell your home if you have a home. But think about keeping balance here, because no one can predict what these people have in store for us. But to me, it doesn't look good at all. So be very, very careful, everybody. Thanks for being here for this update. Stay well. Until next time, peace.